You call it investing. But late at night, when the screen is dark and the excitement is gone, it feels like gambling. Not because you're reckless, not because you're stupid, but because you've lived the same cycle so many times that your brain has stopped believing your own label. You buy when the story is hottest. You sell when the pain is loudest. You tell yourself you're long-term because you want to be, but your behavior keeps voting against you, and the market doesn't punish bad intentions. It punishes confusion. So here's the uncomfortable promise of this video. In the next few minutes, you're going to find out, honestly, whether you've been investing or speculating with better vocabulary. And when you're done, you'll have something most ordinary investors never build: an identity that your future portfolio can trust. Because Benjamin Graham's great insight wasn't just about valuing stocks. It was about valuing yourself as an operator, about refusing to live as a passenger in your own financial life. Let's start with a truth most people avoid. Your returns aren't only determined by your strategy, they're determined by your temperament. And temperament is not a mood, it's a system. A system that decides what you do when prices move fast, when headlines scream, when social media turns investing into a sport, and when your own fear starts calling itself risk management. If you've ever said, "I know what I should do, but I can't do it," you're not alone. That sentence is the sound of a missing identity. Because when you truly know who you are as an investor, you don't need daily motivation. You need a code. And a code doesn't argue with your emotions. It outlasts them. Now, I want you to picture a simple scene. It's not dramatic. It's ordinary. You open your investing app. A stock you've watched for weeks is exploding upward. Green candles, big volume. The internet is excited. And your brain whispers the most expensive sentence in finance. Don't miss it. So you buy. Not because you've studied the business, not because you've weighed the risks, not because you've compared price to intrinsic value. You buy because you want relief. Relief from the fear of being left behind. And then the market does what the market always does. It changes its mood. The stock dips, then it dips again. Now you're checking the price like it's a heartbeat monitor. You're not analyzing, you're watching. And watching becomes suffering. And suffering eventually becomes action. You sell, telling yourself, "I'll buy back later when it looks better." But later, the price is higher, so you wait. And the cycle starts again. This isn't investing, it's emotional leasing. You rent confidence for a few days, then pay interest in regret. And here's what hurts. You can do this for years while still calling yourself a long-term investor. Because the label is easy, the identity is earned. Benjamin Graham gave us a definition that cuts through every excuse. An investment operation, he said, is one which, after thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Read that again, slowly. Not might return a lot, not has a great story, not everyone's buying. Thorough analysis, safety of principal, satisfactory return. Everything else is speculation. And here's the twist. Graham wasn't insulting you when he said speculative. He was warning you. Because speculation isn't evil. It's just dangerous when you pretend it's something else. When you mix gambling with retirement plans. When you mix adrenaline with compounding. When you mix hype with your future. Most people don't fail because they picked the wrong stock. They fail because they lived in a false identity. They said investor, but acted like a player. And the market loves players because players provide liquidity, players provide volume, players provide the emotional fuel that pushes prices away from value. Mr. Market doesn't need your intelligence, he needs your impatience. Now, before we go further, I'm going to give you an audit. 5 questions, no jargon, no spreadsheets, just honesty. And if you can't answer these questions clearly, then the gambling feeling you've had isn't a feeling. It's your conscience doing accounting. Question 1. If your stock drops 30% tomorrow, do you know exactly why you own it? Not because I believe, not because it's a good company. Exactly why. What changed in the business? What didn't change? What part of your thesis is still intact? If your answer is, I'd panic, then you didn't buy a business. You bought a price. Question 2. Can you explain the business without mentioning the stock price? Could you describe how it makes money, who its customers are, what could break it, and why it has a durable advantage without saying it's undervalued or it's going up? If you can't, you don't own knowledge. You own hope. Question 3. Do you have written rules for buying and selling that were created before you got emotional? Because if your rules only appear after the market moves, they're not rules. They're rationalizations. And rationalizations are what gamblers call strategy. Question 4. Do you measure risk as the chance of permanent loss or as the discomfort of volatility? A defensive investor expects volatility. He prepares for it. A speculator treats volatility as a personal attack. One sees a price swing. The other sees a verdict. Question 5. Would you feel comfortable holding this investment if you couldn't check the price for 12 months? If that idea makes you anxious, then what you want isn't ownership. You want control. And the market never gives you control. It sells you the illusion of it. Now score yourself. If you had 3 or more no's, listen carefully. You're not broken. You're just unclassified. And that's the real issue. Because Graham didn't design investing for superheroes. He designed it for ordinary people who needed a sane framework, a way to stop pretending, a way to choose. Because in Graham's world, you don't get to be everything at once. You don't get to be a conservative investor on your taxes and a reckless speculator in your behavior. You choose an identity, and that identity dictates your actions. Graham gave us 2 honest paths, the defensive investor and the enterprising investor. And the market punishes the third imaginary type that most people try to be, the enterprising return investor with defensive effort and speculative behavior. That person wants professional results without pure professional discipline. He wants the reward without the responsibility, and the market charges him tuition over and over. Let's talk about the defensive investor, because most people secretly belong here, and that's not an insult. The defensive investor's goal is not brilliance, it's survival, it's consistency. It's protecting the downside so time can do the heavy lifting. The defensive investor accepts something most people can't accept. I don't need to be smarter than everyone. I need to be steadier than myself. He uses diversification. He avoids leverage. He avoids stories that require perfection. He demands a margin of safety, not because he's pessimistic, but because he's honest. Honest about the world. Honest about business uncertainty. Honest about his own emotions. The defensive investor doesn't try to be a hero. He tries to be unbreakable. Now the enterprising investor is different. Not better, different. The enterprising investor takes on more work, more analysis, more selectivity. He's hunting for mispricing. He's willing to concentrate when the odds justify it. But the price of that opportunity is discipline, real discipline. Not the motivational quote kind. The kind that keeps you rational when you're alone, wrong, and early. The enterprising investor doesn't buy because it's exciting. He buys because he's done the work, and he's built protection into the price. Here's the key. Both paths can work, but neither path works if you mix them with speculation and call it long-term. Because the moment you lie about your identity, you lose your compass. And when your compass is gone, Mr. Market becomes your captain, and Mr. Market is not stable. Graham's Mr. Market is a business partner who shows up every day offering to buy your shares or sell you his. Sometimes he's euphoric. Sometimes he's depressed. Sometimes he offers a ridiculous high price. Sometimes he offers a ridiculous low price. And the genius of Graham's metaphor is this. Mr. Market's job is to give you prices. Your job is to decide whether to act. But modern investors treat Mr. Market like an authority figure, like a judge, like a god. They don't use prices, they obey them. And that's why they feel like gamblers, because gamblers don't have a process, they have a reaction. So let's expose the 4 disguises speculation wears when it wants to call itself investing. Disguise number 1. I'm long-term, but I need it to go up soon. That's not long-term. That's short-term anxiety in a long-term costume. Disguise number 2. I did research. And by research, you mean you watched a video, you read a thread, you absorbed someone else's conviction. That's not analysis. That's emotional outsourcing. Disguise number 3. I believe in the company. Belief is not a valuation. Belief is not a margin of safety. Belief is not a moat analysis. Belief is what people say when they don't have numbers. Disguise number 4, I have conviction. But conviction built after you buy is often just ego defending a decision. Real conviction is earned before the purchase. It's built on understanding, and it's protected by price. Now, if you're feeling exposed right now, good. Not because shame is useful. Shame is not useful. Clarity is useful, and clarity begins with one sentence. I will stop calling my impulses an investment plan, because here's the hard truth. If you don't choose an identity, the market will choose one for you. It will turn you into liquidity. It will train you to chase. It will condition you to fear red and worship green. And slowly, it will separate you from your money without ever needing to crash. It will do it with 1,000 tiny decisions. Now we shift from diagnosis to cure. I'm going to give you a code of conduct. Simple rules. Not because simplicity is childish, because simplicity is what survives emotion. Rule 1, no written thesis, no purchase. If you can't write on one page why this business is worth owning, what could go wrong, and what price makes it attractive, you're not investing, you're improvising. And improvisation in markets is expensive. Rule 2, price is never your reason. Price is an offer. An offer can be attractive or absurd, but the offer itself is not the logic. If your reason to buy is it's going up, you're buying a mood. If your reason to sell is it's going down, you're selling a mood, and moods are not fundamentals. Rule 3, margin of safety is not a number. It's a lifestyle. It's the habit of building space between you and disaster. Space between what you want and what you can afford. Space between your confidence and reality. Space between your plan and your emotions. Margin of safety exists because you are human, because businesses are uncertain, because the future won't cooperate. If you demand perfection from your investments, you'll pay premium prices. If you demand safety, you can survive imperfection. Rule 4. Use a checklist before you act. Because in the moment, your brain is not a truth machine. It's a comfort machine. It will justify whatever makes the anxiety stop. So your checklist must include questions like, what do I know that is true regardless of today's price? What is the downside if I'm wrong? Am I buying a business or buying approval? Am I acting because the market moved or because value exists? And rule 5, the rule most people avoid. If you're not willing to study like an enterprising investor, choose the defensive path with dignity. Because being defensive is not being lazy. Being defensive is being honest. It's saying, my edge is not brilliance. My edge is avoiding mistakes. And avoiding mistakes is underrated because it doesn't feel exciting, but excitement is not an investing objective. Now, here's the moment where most people nod and then go back to the app tomorrow and do the same thing. So I'm going to give you something stronger than inspiration, a 7-day reset. Not a hustle challenge, a reclassification, a way to become the kind of person who doesn't need to try hard to act rational. Because when your identity changes, your behavior follows. Day 1, write your current identity as it actually is, not as you wish it were. Be brutally specific. I chase hype. I check prices constantly. I buy without a thesis. I sell to end discomfort. You're not confessing. You're diagnosing. Day 2, choose your path, defensive or enterprising. No fantasy third option. If you choose defensive, accept it fully. If you choose enterprising, commit to the work. Day 3, create your buying checklist. 1 page, plain language. No complexity to impress yourself. Complexity is often ego. Day 4, create a cooling off rule. A mandatory pause before buying. It can be 24 hours. It can be 3 market sessions. It doesn't matter. What matters is that you stop buying at the peak of emotion. The pause is your margin of safety against yourself. Day 5. Define what you will not buy, your no list. No leverage you don't understand, no companies you can't explain, no stories that require perfect execution, no hype that depends on strangers staying excited, because what you refuse is who you are. Day 6, build margin of safety in your life. Not just your portfolio, cash buffer, lower fixed expenses, more time margin, less desperation, because people speculate hardest when their life has no room for error. When rent is due, every stock becomes a lottery ticket. Day 7, write and sign your investor contract, not for the internet, not for your friends, for your future self. A few lines that say, I will not confuse action with progress. I will not call speculation an investment plan. I will respect risk, not deny it. I will demand a margin of safety. I will measure success by the quality of my process. Now, come back to the scene we started with. The app opens. The stock is surging. The internet is cheering. Mr. Market is loud. And the old version of you would feel that itch, this need to do something. But now, you recognize the feeling. You label it. You don't worship it. You don't obey it. You let it pass like weather. Because you are no longer renting confidence from price action. You've built something better. A stable Identity. And that identity doesn't need constant stimulation. It needs only one thing: time. This is why Graham's philosophy ages so well in a world addicted to noise, because the world is teaching you to react, and Graham is teaching you to think, to slow down when prices speed up, to protect the downside so the upside can take care of itself, to stop trying to be impressive and start trying to be durable. Most people want a stock tip. They want certainty. They want a guarantee. But intelligent investors don't demand certainty. They demand safety, because safety is what allows you to stay in the game long enough for compounding to become inevitable. And that's what this channel is. Not a place to get excited, a place to get steady. Daily notes to train your mind to invest like a true intelligent investor. So here's your closing question. Quiet, but sharp. When your future self looks back on your financial life, will he see an investor? Or will he see someone who called it investing, but lived like a gambler? Choose your identity and let the market do what it does, because your job was never to predict. It was to prepare.